Don't be rumble, float like a butterfly, and sting like a bee. Ah, rumble, young man, rumble. Down goes Frazier! Down goes Frazier!
It's time to get in the ring with the Cornermen, preparing dentists for the next round. We give you business insights, trends, and timely information. And we'll interview experts to help you make smart financial decisions. Now, here are your Cornermen, Rob Joyce and Mike Bark.
Hey, welcome to the Cornerman, Bull Moose's podcast for dentists. And today we have joining us Brian McManus from First Federal. We thought it'd be really valuable to have a banker on, kind of give us some updates on all the different things going on in the interest rate environment, the PPP and what have you. And we just wanted to invite him on and kind of let us know about his bank, but also answer any questions you have, and we're going to introduce some of the questions that we've all been hearing from you. So Brian, why don't you give us a little update on, or tell us about First Federal and what you do over there?
Well, thank you. I am the Senior Vice President in charge of lending for First Federal Bank of Wisconsin. We are a community bank with soon to be 5 locations around Southeast Wisconsin, based out of Brookfield, Waukesha, and now Milwaukee. Actually just acquired Mitchell Bank down on National and Mitchell, and opening up a new presence down in that area. So we're excited to increase our Milwaukee presence coming here. And as you mentioned, we work with a lot of service providers, a lot of dentists, and other offices within our portfolio as well. So as we were just speaking offline, it's a topic near and dear to our heart because we're having these conversations pretty regularly.
So Brian, we're back to school. Kids are some in school, some at home. We're kind of 6 months through the beginning of COVID. What do you think, what should people be doing now that they're kind of back to work and focused too with their business banking relationships? What are some things that you'd recommend, like lines of credits? What should people do with those? Revisiting those, getting them renewed? Can you talk a little bit about that?
Well, that's always one of the questions, right, that keeps popping up. What's the new normal? And I'm not sure we all necessarily know that we've hit that normal yet. However, my advice and my discussions with a lot of clients is to continue to try to maintain cash and availability, right, without necessarily knowing where we're at in the cycle or what tomorrow brings. It's nice that you reference kids in school. I'm hoping next week we're still in that same position with some of them. But with everyone personally not really having a full understanding of what their situation will be going forward, and the same thing I think you have to assume with your businesses is making sure that people have access to credit. So whether that's also having access to a large amount of cash, I think it's also wise to have access to a line of credit that you can tap into, jump in and out of as the situations arises. Also in the interest of trying to preserve your cash. If you're using cash and you burn through it, your margin for error gets much smaller.
And part of that, a question a lot of our clients have had is the EIDL. Should I take it? Should I not? A lot of them, most of them have got the PPP, so they know how to get cash and bucks. And they were pretty sound on their bank accounts were nice and full.
Right.
But then they're like, well, there's this additional 149 out there that I can grab from the EIDL. Should I take it? Is the right strategy take it now just in case there's another downturn and keep on it and hold on to it? Or would you rather see them wait and hopefully tap something that comes down the line?
Well, if you qualify for it, I'm not sure that that's a bad idea. I've had a number of clients who've gone ahead and taken advantage of that. I mean, it's 25 or 30-year money at an interest rate of less than 4%. So from a cash flow perspective, it's nice to get that influx without having to have high debt service as a result. Yeah. And we'll probably mention this a couple times today, but I think this is where it's really important to really understand what all the impacts will be before jumping into government loans, as we've all realized through the PPP process as well. But the importance of having a strong relationship with your banker and with your accountant, and realizing that you understand what tax impacts may come from this and what that impact may have on other parts, say, of your banking relationship. Megan mentioned lines of credit beforehand, but if you jump right into the EIDL loan, understand that that is something that you're going to guarantee, and that the government is going to place a lien on all your business assets of. Mm-hmm. So if you close on the EIDL loan and then want to come back right to a bank, it's going to be tougher right afterwards to secure new funding without figuring most banks aren't going to lend into a second lien position. So I think getting the order of that right, or having a plan, is important rather than just going and grabbing the money.
So line of credit first, which most of our clients, I believe, all have. But if they don't have a line of credit, that gets in place before like the EIDL would come, because the EIDL would impact the line of credit, obviously.
It could, right? So just at least understanding those options, or whether or not you want the debt and can justify that you actually need it, right? Like it's a loose test for the qualification there, but make sure that you can actually check the box that says, yes, I needed this loan. I'm not sure that's a fight you want to get into the government with down the road.
Sure. Yeah, I think some of our clients were weary of it, but then like, I do think I may have a downturn, or I suffered the past 2-3 months, and the cash was nice to have just in case I do get another downturn. And I think there's also some concern about, okay, if they're offering this now, is there any guarantee that if we do have another closure, God forbid, in a couple months, that will also offer something at that point? And do you see anything? I know it's hard to predict, but what would be the other things that the government could do to kind of open up the financing?
Well, as far as opening up financing, there's always talks about, was there going to be another round of PPP or some sort of stimulus if this happens? We're still trying to close the loop on the first round, so to speak. However, the terms on this EIDL loan are extremely favorable. And I think that's helpful, that if you do qualify and you can make good sense of it, that's an attractive product. But understanding what the impact may be in the next round is hard to see. The PPP in general has been a moving target. And are you now looking at a case to where maybe they do offer up another round, which may be more favorable than the EIDL, but you don't qualify before you took this? And you just can't, it's hard to answer, because it seems like something that changes every week, and it's really kind of hard to look down the road. But it wouldn't surprise me at some point that they're not going to let people take a first round of PPP, an EIDL, a second round of PPP, and whatever else comes. So, if you don't need it, I guess I would be somewhat leery of having to take it or understanding the impact. The other thing that's come up a lot on that PPP piece is what's going to be the tax impact on the forgiven portion. So all of a sudden you got this free money, which essentially turned into a grant. And now if you get stuck with a big tax bill at the end of the year, it may have helped your cash now, and you may be paying the price for it early next year.
Yeah, not to put you on the spot, but do you have any that's what our clients are all wondering, like updates on, will that be non-taxable at some point? Will they shift that? Is there anything coming through, or have you heard anything?
Well, I've heard lots of things. The first and most important piece I've been looking for is any new stimulus plan. They've really been trying to push on a blanket forgiveness for any client that took less than $150,000, to where hopefully in that case, it would more or less just be an acknowledgement that you were eligible and that to receive the funds and that you used them in the right way. Then this whole taxable portion's been bouncing back and forth. But the more that I've been reading into it as it stands now, it does look like that is going to be taxable, and that's going to be a huge impact if that doesn't change. So a lot of people are hoping that gets addressed, but right now it's hard to get any consistent answers until something becomes law.
Have you guys processed any of the forgiveness applications yet with your bank?
Yes, would be the first answer. We've probably processed about a good 10. A lot of those smaller ones that are under that $150,000 threshold, we've been having discussions with our borrowers, trying to wait on a definitive answer from Congress, because it's a lot easier to submit if it's going to be more of an acknowledgement on those loans. The forgiveness portals opened August 10th. We submitted some of our first ones August 11th and still have not received any acknowledgement back from the SBA. They've shot clarifications as to how to properly enter versus correct errors that may be out in some of the stuff. And we've checked, and everything out there says pending validation, and we're now 30 some days in. Keep in mind the SBA does have 90 days to decide on these. And once you've submitted that application, it stalls you having to make any repayments on your principal or interest. So just by submitting at least stalls that process. But we've not seen resolution on anything yet.
And from the taxation side, and this is important for our clients to understand, whenever you take the loan, it's not a taxable event, but when you receive forgiveness, it will be when the taxable event occurs. Correct?
That's my understanding.
Yeah. Yep. So, and again, this is important because if we get into October, November, we're filing and the SBA takes 90 days to actually get forgiveness on the debt, then it becomes taxable in 2021 as opposed to 2020. So,
which may be preferable and give you a year to kind of plan that out accordingly.
Well, we're also in an election year too, so who knows what's going to happen with the taxes.
Yeah, I think if we try, some of it, a lot of our clients have been asking, like, what should I do? When should I do it? there are so many variables at play that I think if you try to game it and try to figure it out, you might just, you might go crazy trying to figure out what's best. But I think everyone just needs to understand that, will be at the time of forgiveness, not just when you apply. If you end up applying, December 31st, then you end up taking a taxable amount this year.
Okay. Right. I find that most people who have been asking me about this, what they're wanting is the certainty that this can get in and get approved. They're worried that they're going to get tripped up on something. They've seen the moving markers from the government on a lot of stuff, and they just want to make sure that they can get their portion forgiveness. And I haven't heard as much yet as to what the tax impact will be from the clients, but that will come as they get to their year end. So, hopefully they are having proactive discussions with their accountants beforehand, before it's too late to make adjustments for this year.
Sure. And I think that, a lot of people were asking, well, how do I know I'm going to get full forgiveness? And there was concern, like they wanted the certainty about, I'll get full forgiveness, right? It's like, yes, don't worry about it. You would have to go through a real shift in your business because of the extension to 24 weeks on the payroll, the ratios on the expenses and the payroll going to 60-40. I think your business would have to shift dynamically for you not to get full forgiveness for the full PPP loan. So I think, from our side, it's like the certainty is the forgiveness. Now it's just the uncertainty is the taxable or non-taxable portion.
Yeah, I think the biggest portion is, did you keep your staffing level the same as what you applied for? And in some cases that may be no, but what I've heard a lot of is if you applied and you had 10 people and now you've only got 8, if it was your intention to try to bring those 2 back, and we've had people who've just voluntarily walked away and chosen not to go back to work or go somewhere else. And the new applications do address that if you offered them their same position back at their same level, that, there's some coverage there, you're not getting penalized. But that's the other trap with the 8 and the 24-week piece, is if it took you 10 weeks to use that money, you can file under the 24-week rule, but you still have to hold that staffing level and certify to that through the full 24 weeks. So even if you've already applied for forgiveness now, you need to make sure that your staffing in December or whatever still represents
an
that.
attestation to that, or do you just, you have to sign something at the end?
You will have to sign some too that's acknowledging that you are intending to keep that through that point, and everything's auditable at the back end as well.
So going back to having cash and availability, do you have a recommendation of what you like to see in your customers' checking accounts on a day-to-day basis? I know it's probably personal for every situation, but is there a good rule of thumb they can use?
I guess a long-standing rule we've used a lot, and that's a good question because people do ask that, is enough to cover at least 2 cycles of payroll. Not necessarily 2 weeks, but 2 cycles. Just because I think if you've at least covered that, you can weather most storms and it gives you time to plan. I want to be very clear on this point. It's 2 payrolls plus payroll taxes. I find a lot of times when people struggle, that's the first thing. They want to make sure they pay their people and we'll catch up on the taxes later. And I would suggest never making that part of your strategy. With those being essentially trust funds that are forwarded on. Really what you want to do is make sure that you can get through about 2 payroll cycles. Some people like to cover 2 months of all expenses, or a full month of all expenses. That's not always realistic for most clients, but enough to make sure that you can get through 1 to 2 payroll cycles, at least buys you the comfort of time to whether you need to go out and try to secure an additional loan, whether you need to secure some private money or weather whatever storm you're facing. If you can get through 2 payroll periods, you're normally in a pretty solid situation.
And the line of credit kind of shifts that too a little bit, or your comfort with that. If you have 1 full month or 2 cycles of payroll, as well as a line of credit to back you up just in case, then there's a big comfort level there.
It is, or at least that availability in the line of credit. And we've discussed this in the past as well, but having a $100,000 line of credit doesn't do you any good if you regularly maintain $90,000 to $95,000 outstanding balance on it. So the key is always to make your line of credit actually revolve. Use it to fund your short-term cash flows. You get in $50,000, then pay it back down. But the line of credit really should be able to help you through timing. It's not a permanent use of cash because now you don't have that fallback. So even if you're not sitting on that full period of cash, like you're talking, if you have that availability that you can borrow on, is just as good, but you need to have one or the other. Both is preferable, but having a line of credit that you're just letting there sit fully borrowed doesn't help you when the chips turn against you.
So if there's people out there that don't have lines of credit right now, what would you need to see from them if they want to apply for one? What would be a slam dunk? case?
Well, slam dunk obviously always depends on the borrower, but I think when you're wanting to approach your bank and look for that, it always makes sense to probably have 2 years of financials, 2 fiscal year ends of either your year-end financials or tax returns and your current year performance. And then the one that kind of gets everybody, and don't be surprised to hear this question, is they're going to ask you, what are your expectations or what's your projections for this year? Banks can make some assumption off historical data, but what we're also looking is, how are you going to pay this money back? How are you going to do going forward? And especially in a year like this, you can't just assume 2020 is going to look like 2019 when a lot of stuff happened. So don't be surprised to get asked to say, okay, I've got your numbers through June 30th. Where do you think you're going to be on December 31st? And we all understand that that's a guess at this point, but you are more able to accurately guess or portray what your answer will be than I am from the outside. You can have a feeling as to what's the flow of new clients or your clients coming back. So if you actually do that as part of your internal process, your projections would probably be asked as well. But if not, don't be surprised if you get that question, because I'm trying to see how you're doing going forward to make sure you can pay my loan back.
And how much does equipment financing and stuff like that impact maybe the ability to get a line of credit? Our clients will get the offers from supply guys to, hey, 0% interest, and you're just taking this on. You're paying for the $60,000 equipment over the next 2 or 3 years with no interest. So they'll take that, but obviously that's debt that they have to service. Does that impact it more? Would you rather see that or more cash in the bank account?
It depends on everyone's situation. When we're going to underwrite the loan for any type of loan or for a line of credit is really trying to understand what is the debt that you are servicing. Mm-hmm. So you may have 5 of these leases out there, and we're going to build that into our models because I need to make sure after you've covered that debt that there's enough to continue to cover this debt. And there's normally a ratio that a lot of banks will look to. But the good point is if you have, say, $10,000 a year worth of debt service, which I know it's not much there, it's less than $1,000 a month, but we'd want to see $12,500 clear to do it. Normally about 1.25 times of your minimum, just to provide you a little cushion to make sure that you can cover all your debt. And that's your principal, your interest, and any lease payments that the company is able to generate, enough to cover that plus a small cushion. And that's pretty common.
Gotcha. So your debt service ratio is at 1.25 and clear of all your debt, and that includes everything. You're not taking anything out from that debt, any payments that you're making on a monthly basis.
Right. Yep. I would like to see that after you pay yourself to make sure that's the amount that's getting left in the business to be able to cover that.
Another question we get a lot, clients looking for their monthly statements from us. So, we keep up with everybody monthly, so they're able to work with the bankers. But personal home resident refinancing, have you seen a lot of that activity? Are the rates as low as they're going to go right now?
I would have said yes to that 6 months ago. They've obviously gone lower, but I think you're getting to a point. We've been sitting at what's been historic lows ever, right? All the time you see, it's never been lower than this, and it's been dropping lower, and it's to the point to where we have been sitting at near record lows for the past couple months. How long that lasts, I don't know. The Fed came out last week. They didn't give many indications of any near-term increases to interest rates. However, you're sitting at a point now to where a person with good credit can get a 15-year mortgage for, about 2.5%, but you can get into a 30-year mortgage at 2.75%. We're actually at a point to where you can have less than perfect credit, still good credit, and still be 3 or sub 3. And I think that's amazing in the market. And you're seeing all sorts of people not only taking this opportunity to purchase homes, and a big flurry of refinance activity. We've had people who finance their home in January, February, refinance it back again this summer because they're still saving another 50 or 75 basis points per month.
And what do you recommend on the refi? You need to be able to save at least, I've heard the rule of 1% on your mortgage. Maybe it sounds like less, but when should you refi? What would you recommend it?
The general rule that we've heard from a lot of people to justify it is if you can probably at least 50 basis points. Mm-hmm. But it's 50 basis points roughly if you can get in without paying fees, right? So there's always closing costs that are built into that. So it's probably closer to 60 to 75 basis points. And if you roll that in, you still save a net 50 basis points. And that's what we've seen a lot of people do. And it doesn't make a lot of sense to have just refinanced earlier this year and then pay $2,000 in fees. Some people it does over the long term, but a lot of people when you're worried about conserving cash. But 50 basis points seems to be the number that moves a lot of people. And when you look at that over 15 or 30 years, that extra $200 or $300 a month gets to be some real money.
Yeah, I think in terms of the timing of the refinance, when kind of COVID all kicked off, we had a lot of people coming to us saying, I need to refi right now. Like it was going, like interest rates were going to be falling, like just dropped and running right back up.
The first week they were on it.
Spiked.
Everyone's on, and like, okay, our thought was like, we're going to have an extended period of interest rates. And you touched on it a little bit. I know it's hard to kind of have the crystal ball, but we do feel like these rates will be extended. The Fed gave very little indication on what's going to happen next, but I feel like these rates will extend for the next couple of months, and there's not a need to like get everything in today, right?
Well, the one issue that I would say on timing is they were about to impose what was about 0.5% fee on the Freddie and Fannie Mae loans, which were starting to get priced into the market. And while that didn't move the needle a lot, it was probably costing people another 1/8 to 1/4 point. That was supposed to roll out at the beginning of September. There's obviously a lot of pushback that now was not the time to recapture additional fees on some of those federal loans. So the government did postpone that for now, but they didn't cancel it. So starting December 1st, if nothing changes, that still comes to play. Mm-hmm. So if you're really working on what your best rate is, the rate's probably going to be better to lock in before mid-November, because a couple weeks before that, that'll start getting locked into the long-term pricing, unless it gets pushed again. But right now it's set to come back and get implemented December 1st.
Okay. So yeah, we do have, there's a little bit of a push. September, October would be the time to do it. November is probably the latest time that they'll be able to get in their refi before those rates pop up. That's all.
Right. I mean, it shouldn't pop up too much, but why wait when you can lock in lower now? Sure. I think is always the advice.
So does the same thing apply with the business loans? I'm guessing the rates there are down. Is that the 50 basis points kind of the threshold, or is that a different analysis?
I would probably look at that differently. Business loans are a little different animal. Sometimes if it's a straight real estate loan, right now you can probably look, and I think rates are extremely competitive at this point. You can probably look in, again, for a decent client, anywhere between 3.5 up to 4.5. You won't see too much above that in some of those areas, depending on how strong the company is, how strong the guarantor that supports it. Historically, that's still very great rates. As far as your more traditional business loans, I think the timing is always really based more off what your relationship and what your needs are. Mm-hmm. Lines of credit, other term notes, those aren't always as easy to refinance. And obviously the thing you always have to take into play is, are there prepayment penalties built into your loan? If you get a chance to save 75 basis points, but you got to pay a 200 basis point fee to break the existing contract, that may not necessarily be beneficial for you long term. But I think if nothing else, this is a good time to at least be having discussions with your bank and kind of having a long-term plan as to, are we sitting right with our debt load? Are we properly on here? Do we need to increase our line of credit? Do we need to look at our pricing? Do we need to structure for what's going forward? I'm not sure that just sitting there having had something in place 2 or 3 years ago and just letting it roll is always the best scenario. I think it's always important to keep communication open with all your professional contacts, your bankers, your accountants, your attorney, everything. And I think this is a great time to be reviewing all those.
So yeah, this is the year to kind of talk to your guys and see who's in your court. What would you recommend for people with their banking relationship if they weren't happy with, maybe we had several clients who weren't really happy with how the PPP application process went. How do they start these conversations, and what would be a good thing to look for?
Well, first of all, obviously there was a big catastrophe that hit our economy earlier this year. But for a lot of community banks like I work for, it was actually a boon, right? Like the always argument is, how do you compete with the big banks who have all the advertising money and all the power behind them? And what I think that the PPP allowed us to do was help to level that playing field, because I think a lot of people got to realize what happens when you can get kind of that personal touch and that personal relationship. Mm-hmm. So us personally, we've received a lot of new clients that came from some of those big banks, and I want to be careful with that because I used to work for big banks myself. And while I like the clients, but they're going to prioritize like everything else, right? Like when PPP comes in, I'm dealing with my $10 million clients and then my $5 million clients, and everything would work down. That's just how they have to play to protect their assets. Where I think the community banks deal with a lot more family owned and smaller businesses, and there's just a little different layer of a personal relationship and a personal touch with that. And I think that's the same thing to look for, is you should always look for in a relationship, whether it's banking, whether it is with your accountants, your attorneys, anything, is to try to establish a rapport. Look for someone who's really caring about who you are, who understands where you're trying to go and where you've been. And I think it's a lot easier to stay in constant contact. Don't sign up for a loan and then just make your payments, never talk again. Fortunately, your banker should be reaching out and trying to be on a regular basis with you. You mentioned meeting with your clients monthly. Well, we tend to try to have those same touch points, understand where are you going, what are your challenges, and then if you have a hiccup, it makes it a lot easier for us to work with you because, like most people, we don't want to get surprised. And when you get surprised with negative things, it's harder to react. But if we've been having conversations, understand your plan, how you're going to address it, it makes it a lot easier to work through issues. And I think those are the differences that community banks can provide that sometimes the bigger banks, especially if you're smaller and you're just a name on the list and you have a hiccup, it's sometimes something they just don't want to deal with.
Yeah, we've always kind of remained agnostic on the bank side with big banks or small banks, but whenever someone asks us for, giving you a referral for a banker, it's always been, well, here's 3, go talk to them. Whichever one you have the best relationship, you go with. Some people like the fact that there's a large bank that has multiple locations that can drop off anywhere. They'll always see it. The technology is really good on one side, and other people prefer, all right, I want a personal relationship, someone really local. And I do think that during PPP, you're able to shine when you do have that real small personal relationship that's local and there. So, we've always we don't try to play the field on it. We just think that there's a multitude of people, what people want, and they end up going to find it. We don't want to just direct them to, you need to go with this bank because they have the lowest rate. And I think that's the other thing that we always try to impress on our clients too, is don't just go rate shopping. I feel like they all get very competitive, and one bank is 1/8% below the other. So I got this guy down to this much. Do you believe it? It's like, yeah, but what's your service going to be on the other end? Like, did you look at that at all? Do you understand the relationship? I'd rather have you have a great relationship with a banker and pay 1/8% higher than maybe somewhere else that was able to go just a touch lower. So that's kind of where we come in at, I guess.
Well, I have that same conversation. I've had a lot of clients who I've referred business consultants to as they've needed it, whether they were struggling through certain periods or whether they have huge growth periods and wanted to make sure that they can maximize it. Same thing, I would align them with 3 different people, but I would look at who you are and then try to align personalities of some of these, because I think, same way, whether it's your banker, your accountant, your attorney, or a business consultant, if you can't necessarily trust and work with that person and align the personalities, you don't really get the best of it. And we try to do the same thing with our banking relationships, is come into it. How does this relationship feel to you? Do they care about what you're doing and where you're trying to go? Yeah. And I think if you can answer that, that's going to be the foundation of any relationship, but it's 2-way. You also have to communicate back so that the other parties fully understand where you want to be.
Gotcha. How often do you communicate with some of your business? Like, how often would you say is a good time to touch base with your banker? I know that obviously when things like this happen, everyone's calling on you, but is there a time they should check in? Would you like to hear from them regularly, scheduled, or kind of just meet with them, or just when there's problems or there's issues with cash flow?
Well, obviously no to the second part. I would like to help you before we get to a lot of those issues and try to see what we can help out with on those months. I think you should probably be having touch points at least once a quarter.
Yeah.
We do have clients we're touching base with every week just because there's something going on or they just like to bounce ideas. I've got people who are just regularly kicking ideas off that, and they almost look at us as part of their management team.
Sure.
I can't make decisions for them, but they just want to say, hey, what would happen if I did this? Or does this look like a good idea? I would think if you have a good banker, though, they should be reaching out to you regularly, too. It shouldn't just be on you reaching back to them. But I would think that at least once a quarter, you should be having at least a brief touch point, even if it's just saying everything's going great. I think I'm fine right now. But if nothing else, a quick 5 or 10 minute call. But I think at some point you have to have the expectation of your banker wanting to have that relationship with you, not you always just having to reach out as well.
I think that brings up a good point. Just that, accounting, banking probably is viewed sort of as a commodity and you're trying to find the cheapest thing. But for small businesses, we are sort of an extension of their business and their management team. So I think people need to keep that in mind when they're searching for their next accountant or their banker. Just that it's more than the cheapest fees and the lowest rates.
Well, I think there's always a description to that, right? Like everyone just sees the word fees and it just gets everybody somewhat agitated. And I think that's always our challenge. I hit that quite literally every single day as a banker, obviously. and I'm sure you guys do the same thing, but to realize that we're not just a fee or an expense to you, but that we're an added value, right? The thought is if you paid me $5,000 for something, I'm hoping you get a multiple of value in return to that I'm not an expense, but I'm more or less an investment. And I would think that's the same way from your standpoint, from a good attorney. And that's part of building these relationships, is to really kind of keep that all in place. And then, like you said, reaching out, well, just when there's a cash flow issue or something else comes in. If you've got all these relationships in place and everybody's working and pulling the same direction, you can pull through most anything in your business that hits you when everyone can plan appropriately or maybe see it before it hits the bottom.
Mm-hmm. Yeah, can you go down? We did have some, we wanted to kind of go through the fees. I think on your side, you kind of wanted to explain that, which I think would be a great thing for our clients to understand the kind of the fee structures, how the banks are charging different things. We touched on it earlier with the refinancing, but do you want to kind of go through the fees a little bit and kind of explain where those come from?
I guess one of the ways that I've always looked at it and compared to, and I have a lot of contractors within my portfolio, and professional services, the same thing, right? A lot of what people are charged is your time and your labor. And, I get into this discussion with clients all the time saying, I don't think I should have to pay any fees. We're paying you an interest rate. Mm-hmm. But keep in mind that really a lot of the interest rate that you're paying is a pass through on the money, right? Like banks are having to pay for either the deposits or maybe they're borrowing more money to get loans. However they're choosing to fund those, there's a cost to that. And while there may be a small markup to what you're paying in an interest rate, when you're seeing the fee, for the most part, regardless of what everyone thinks end up being exorbitant fees, what that really is the labor component. So I look at it as no different than if you got your floor contractor coming in. As much as you want that as cheap as possible, you're never going to be paying for just the material, right? You're paying for him to send out a crew, and you're not probably paying for just what they're paying, but you're paying for whatever that business owner needs to stay in business. Well, banks need to do the same thing. Accounting firms do the same thing. Attorney fees do the same thing. So again, I look at all those professional relationships, those fees that are getting charged are really just kind of an investment in, the advice and the services that you're getting paid for at that point. But a lot of times I think just seeing that name fee drives people a little crazy.
Yeah, it's similar in our side too, is that we charge our fee and a bank charges its fee for X, but you're always doing X plus for the business. Obviously there's advisory work, you're answering emails, you're kind of always available to them. So like the fee is charged for the execution of whatever accounting and tax or whatever it may be, but you're always doing something above and beyond that. And it's always covered in that fee for us. And we're fortunate that our clients most of them are dentists. And they get, no other kind of business, not that there's other businesses, but you couldn't go to a grocery store, grab some food and say, I don't think I should pay this for that, right?
Right.
You wouldn't get the food then, but our dentists run into that where a patient will take care and then say, come back and say, I don't think I should pay this much, where I'd like to pay this much. And so it's difficult for them. So I think they have the understanding and they hopefully appreciate what bankers go through and accountants go through in the service side to be doing the work and just for a flat fee. And so there's usually not too much pushback, but obviously there's some on the bank side too.
Well, it's always a value add. Yeah. Like I said, my sister-in-law and brother-in-law are dentists as well. Yeah. And if I go in and I paid $1,200 to them for a crown, right, for them to create and install any dental work, I guess that I would get, it's not just the $1,200 that I end up paying them for that service. Mm-hmm. I wouldn't pay them if that service wasn't worth more than $1,200 to me. Mm-hmm. Right? Like if I figured that getting that fixed is only a $500 value, then it probably doesn't make sense. But over the long term, I want to have that fixed, whether it's, from a pain threshold standpoint, whether it's for a beautiful smile. There's a larger value than the fee you pay. And I think that same thing comes when you deal with any professional services, is there should always be more upside to it. And I think people just sometimes forget that part. And I think sometimes just seeing the actual word fee makes it feel like it's just extra or excessive. And I think just understanding what that truly goes to makes a difference.
Yeah.
So even though we've been talking about the downturn in the past 6 months, we do have some clients that are sitting on extra cash. Do you have any recommendations? You think everything's still uncertain, keep that cash, or should they pay down some debt, take some out, try to take a vacation?
I'm not sure there's many places they can go on vacation quite as of yet, but I've got a lot of clients and having discussions with them all over the board on this. Until I think we've hit what's more normal, I think sitting on some Some portion of cash is still pretty smart. We talked about that a little earlier as to making sure you're sitting to get through a couple payroll cycles. I don't think you can always rely on a very quick stimulus program like we had before. Fortunately, I think we're in a situation like you actually mentioned, because of some of that stimulus and some of the businesses in certain sectors bouncing back, you're actually running into some clients who are more flush with cash right now. The downside of being flush with cash is because interest rates are so low, deposit rates are also so low. So having that sitting sometimes in your accounts, whether it's a CD, a money market, whatever you've got it sitting in there, you're not getting as big a return, right? It's always a very related relationship with the interest rates. But I still think being somewhat safe and maintaining cash is probably prudent, at least at this point. Obviously, there's lots of plays that you can move to the stock market. Is that always the safest bet with your business cash? And is that always going to be completely liquid when you're going to need it if something comes up? I mean, that's a decision based off how much cash a lot of your clients may be sitting on. Is it worth to distribute that to themselves in order to make that play? But while everyone still continues to use the word uncertainty, I think holding on to a certain portion of cash is probably definitely advisable until we clear, hopefully, at least these next couple months.
Yeah, and part of a little bit of what we talk about with our clients is when they're asking what to do with cash, it's like I can give you the quantitative answer and the qualitative answer, right? The quantitative, I can do the math and tell you, okay, you're
pay down debt or
you're going to get this much return, and you're paying 4% for the money, and you're getting 8% and whatever it may be. So that you get the yield on that, and you get 4%. That's totally numbers, and that's some just think in that sense only. But I think there's a qualitative side, like, does it give you peace of mind to know that all your debt's paid down? Like, sure, your house is at 3% right now, but if it makes you sleep better to have no mortgage and you're going to just feel better about it, well, then you have to put a value on that. Don't come to us and just ask us for the quantitative answer and then go, I went with you because you said to take this money and put it in the stock market, get 8%. I think you have to do the kind of combination, and every client's different on what helps them sleep at night and gives them that peace of mind.
Well, and I think when it comes to paying down debt, if you have a lot of cash and you have an outstanding line of credit, I would probably pay that down because you still have that availability, and it's going to reduce the interest expense you have. On term debt, trying to accelerate that debt to pay it down, and then you've lost access to some of that cash. Maybe if you can completely pay off a loan and it reduces your monthly debt service, might not be a bad idea. But we had talked about this offline, the difference right now on a 15 and a 30-year mortgage, for instance. And this is just my take on it. People do it a little different. But right now, the refinance rates are so similar. As much as you would want to hack down at your mortgage, you can go do a 15-year, and let's say it's 2.5%. But now you've got a $3,000 payment all in to make that done. But if you do it on a 30-year, that payment might be $1,200. You can go ahead and make double payments all you want and knock that down considerably. But then if something comes up in November, December, January, you're only tied to that $1,200 payment. You can save that cash. You're not tied to the $3,000 payment. So I tend to lean towards a conservative view when we're in what they say uncertain times, of which I think you can definitely categorize this as trying to hold cash and or hold availability just in case something happens. Cash flow tends to be my primary focus and the theme of the discussions we have with most of our customers.
It's an interesting point about the 30-year and the 15, because their rates are so close right now that if you really wanted to be in a 15, maybe take that additional quarter point and be in a 30. And obviously it takes a little discipline. And if you're forced to do it on the 15 years, it's easier to make those payments, but force yourself to make the double payments until there's time. God forbid we have the slowdown and you need that cash, then you're not stuck in the 15-year with the higher payments. Obviously, it's a really good point, I think, that you make on those, because they're so similar.
It buys you flexibility, right? Sure. If there's a big gap, then it's hard to make that argument. And I say that because that's what I'm doing myself on this. And then if something happens next month and I don't want to make it, I've had that ability to step back. Or if you signed up on a 15-year payment plan, that's going to force you into a refinance if you need to lower those payments.
Sure. Well, I think we covered what we were looking to cover. Do you have any parting words or anything interesting going on with First Federal?
Well, we talked about our acquisition of Mitchell Bank, which is a big step forward for our bank, and I think will help tie us in a lot closer to Milwaukee as well as our traditional Waukesha roots. I suppose one of the interesting things we got going on is a relationship we have with a company called Operation Finally Home. We've actually got a big outing in about a week and a half that will be going on, and we sponsor a lot of events with this group. David Bellman of Bellman Homes works really closely with this group, and they provide basically custom-built mortgage-free homes for service-disabled veterans. And I think they've done one a year for the past 5 years or so. They're working on the 6th, where they'll donate a lot. They'll fundraise, do the time and effort, and then turn the keys over to a family of a veteran that's come back and has struggled to reintegrate into the workforce with some sort of injury. It's quite an event to see and to behold, to see the family who's just realizing they normally do some sort of surprise event when they
So they're
name
going
them.
into their own week and a half.
No, this is one of the fundraising events. They're actually just going to be starting on what their 6th home is. They did one, I think it was just about 2 months ago, when the family just got to go into the last home, and now they're starting to work on their next plan. But it's always quite a thing to see when they first find out that they've been selected to get a house for free. And you can imagine how much impact that has on someone's life. And then again, they come in once when it's rough, and the next time they show up, you're walking in the front door and there's a little ceremony. And next week or the week after, we have their golf outing again, and a lot of the families come around getting to talk to the people and just seeing the difference it's made in their lives. For the people who've spent their lives, fighting overseas and protecting our freedom, it's quite a humbling experience and a great thing to be a
What
part
was the
of.
name of that? Say that again for any of them.
Operation Finally Home. So, yeah, it's a great organization.
Well, thank you very much for your time, Brian.
Thanks, Brian.
Thank you both.
We'll talk to you soon.
Take care.
Thank you for listening to The Cornerman. Be sure to leave us a review and subscribe to us wherever podcasts are found. For more insights and information, visit us at bullmoosefinancial.com.